Good morning. Welcome to our webinar this morning on Do You Know What Your Company is Really Worth? This is a webinar in conjunction with people who are thinking about buying a business or selling a business, and just often it's a fairly early stage, or just before a transaction, or sometimes when they've been approached or approaching a business to buy. They want a professional view from people who regularly act on transactions as to what the business is worth. So we're covering this morning. We're covering quite a few topics, and we're going to finish with questions and answers. So rather than saving up your questions until the end, if you have any questions as we go through the webinar this morning, you'll see there's a Q&A icon on your screen. Click on that and ask your question, and we'll pick up and answer as many questions as we can at the end of the webinar. So those are the topics we're covering. Starting to talk first about very, very quickly about us, who we are, why we're qualified to talk about valuations. Then moving on to talk about the importance of valuations, difficulties in doing valuations, the subjectivity, the professional judgment needed. We'll talk a bit about methodology and strategic premium. Slightly touch on tendency for SME owners to overvalue in certain circumstances. And then we'll just how we can help and move on to questions. But as I say, please ask questions as we go along using the Q&A icon, and we'll pick up on those at the end of the webinar. We've been going strategic corporate finance for, we're in our 24th year, and we act exclusively for clients seeking to sell businesses and buy businesses. The main transactions we do are trade sales for clients who are often coming up to retirement and want to sell their companies. So selling to corporate acquirers or PE acquirers. And we do quite a lot of management buyouts as well. Often we act for the vendors. Sometimes we act for the management team or the corporate acquirers. But over 20 odd years, we've got a lot of experience in carrying out transactions, making offers on behalf of clients, receiving offers on behalf of clients. And it gives us a really good feel for how businesses are valued in the real world at the time of a transaction when they're actually changing hands. So they're not theoretical valuations, they're not valuations for tax purposes, the real world valuations of what your business is likely to fetch or what you're going to have to pay for the business you want to buy. There's myself, and Greg is going to take us through most of the webinar this morning. And I will come back at the end to host the question and answer session. We give quite a lot of early stage advice. We really believe it's important for clients to have a well-informed view of what can be achieved, whether they're selling or buying. And valuations is part of that. Exit option advice is part of that. So for many clients, we'll talk to them about not just what their valuation is likely to be, what they're likely to receive. And our valuations tend to be pretty accurate because of our, as I said, our real world experience. But we'll talk to them about what deals there's been in their sector over the last few months, not just in the UK, but internationally. And where we've seen press releases issued in conjunction with those deals, what the sort of market sentiment is, why are corporate acquirers buying in their sector, what are they looking for, what ticks their box. So extra option advice in terms of saleability as well as value, and also often for clients looking at different routes. So trade buyers, PE houses, private equity houses, management buyout teams. You compare and contrast the different options, and we do actually do a webinar on looking at the different options, understanding the different options, which I think is coming up in November, if you're interested in thinking about different options for sale. So a lot of early stage advice to give clients a well-informed view as to what can be achieved before they embark on it. It's too late if you put your business up for sale to find out it's not worth anything like you thought it was, or there's major issues that stop you selling your business. So it's that early stage advice which allows clients to then take actions and make changes as necessary. Our mainstream, when we're getting on to the mainstream transaction, if we're selling to a trade buyer, we do an awful lot of research using powerful subscription databases to find potential buyers, not just UK buyers, but international buyers. So we're thinking about why your business is likely to make higher level of profits and therefore have a higher value to a buyer? What can they bring to the party that adds to your business in terms of maybe they've got a much larger geographical spread with sales representatives, or they've got manufacturing efficiencies, or whatever it is. What are the we're thinking of looking for potential buyers. We're thinking about what are the attributes that we're looking for in those buyers. People who can make more money out of your business when it becomes part of their group than you can make staying standalone and independent. People who can therefore afford to pay a decent price and be motivated for wanting to do the transaction. And we advise all the way through to completion. So structuring, management buyouts, in the negotiations, fundraising where it's needed if we're acting on the buy side, and particularly important project management all the way through. So once heads of terms are agreed, which is the outlined terms for the transaction have been agreed, there's an awful lot of work after that stage to deliver the transaction, and we'll stay involved all the way through the legal stage, all the way to the end to make sure the transaction completes and the client gets good advice all the way through. We've been saying over 100 completed deals for 4 or 5 years, I think, so we need to update this slide at some stage, but we've run out of room to fit thumbnail photos on it. But that shows a selection of many of the transactions we've worked on and shows the variety of different industries. So we've got a wealth of experience covering deals across many sectors in the UK SME market. And it's this real world knowledge, as I said at the start, that allows us to give accurate valuations to clients and be confident in the valuations we give, giving clients the information, as I said earlier, to base a decision on whether to proceed with a transaction at this stage or not. So that's who we are and why we're qualified to talk about valuation. So I'm now going to hand over to Greg Barker, who's going to take us through the rest of the webinar, and I'll join again at the end for the question session. So just one final reminder, if you've got questions, please use the Q&A button and ask your question. We'll pick up on questions at the end. Thank you.
Thank you very much, Andrew. Good morning, everybody. So Andrew's already sort of touched on why valuations are important to business owners, but there's various sort of specific commercial and tax reasons why valuations might be needed. So some of those are noted on the bottom of this slide. As Andrew's mentioned, for business owners starting to think about their exit, having a clear understanding of what their business is worth is really important. If a management buyout is being thought about, again, getting advice over what the business is worth is critical. Very often we're asked to prepare valuations for clients where there's a need to buy out one or more minority shareholders. And again, very often we're asked to get involved where there is disputes between shareholders to work out what the market value of a company is and help facilitate a transaction. And sometimes valuations might be needed to determine market value if there's a transaction between family members, connected party transactions, or for probate. But so those are some of the specific sort of reasons why valuations might be needed. I think generally it's really important that all business owners have a clear understanding of what their business is worth and importantly what factors are driving that valuation, and therefore they can make much better strategic decisions that should lead to further growth in the value of their businesses going forward. And by the same token, having a clear idea of the value of your business means that you can avoid some of the pitfalls that business owners sometimes fall into, such as initiating a trade sale process with unrealistic price expectations, setting up an EMI scheme for managers with either too high an option price or too low a price, and that can lead to some severe difficulties further down the line, or buying out minority shareholders at too high a value. So those are some examples of situations we've seen in the past where not having that underlying sort of, understanding of valuation can be very problematic. So valuations can be are quite tricky to get right, and there's sort of different reasons for that. The first is that every company is different, and the valuation for a company one year can be very different to a valuation the next year, depending on the circumstances that the company is in. So it's very difficult to just sort of rely on similar businesses and what sort of multiples that they're getting when looking at a valuation for your own business. It really depends on factors that are unique to your business. There's a lack of comparable data out there when it comes to valuing small businesses, privately owned businesses. And that's because in the vast majority of cases when businesses are sold, the price isn't made public. And even when it is made public, it's difficult to work out what the multiple was for that particular deal, because the reported profits for that business, there might not be any reported profits, or if there are reported profits, they can be misleading. So really, the only time you can sort of try to work out, with any sort of degree of reliability, what price was paid or what multiple was paid for a business is where a listed company is making an acquisition and has a requirement to publish what the adjusted EBITDA was for the target they've bought, and you can kind of work backwards to arrive at a multiple there. But that's only a small minority of transactions. Most of them, the terms are confidential. Another reason why valuations are difficult is, as I mentioned previously, it depends on factors that are unique to that business, and therefore whoever's doing the valuation needs to have a full enough understanding of that business, what growth prospects exist, what the major risks in the business are, in order to come up with a meaningful valuation. And that person also needs to have enough sort of independence and objectivity for the valuation to be meaningful. So it needs to be somebody who's outside the business doing the valuation, but also somebody who's taken the time to learn about that business and understands it in enough detail. And the final bullet point on this slide is that judgment, professional judgment, is needed to weigh up all the different factors that go into a business valuation. It's not black and white at all, and the conclusions from the valuation are often nuanced and need to be sort of communicated and explained in the right way. So it is, valuations are much more of an art than a science. Different people will have different ways of doing it and come to different conclusions, and it's important that the person doing that valuation has the necessary experience and expertise to do that valuation. So finally, for the reasons I've talked about, be very sort of careful about taking free valuations or online valuations, because it's likely that they'll be quite simplistic and could also be biased if people are kind of offering these sorts of valuations for free. So moving on to valuation methodologies. In most of the most cases, certainly most of the valuations that we do for clients, we work out a valuation based on a multiple of profits, and that's the methodology I'll talk about over the next few slides. But there are other valuation methodologies as well. So you might find that a business is valued based on a multiple of its recurring revenues, and that that tends to be certain sort of businesses where that valuation method is used. So, for instance, software businesses, if it's a SaaS business, that can be a valuation method that's used. For distressed businesses, liquidation value, if a business isn't sort of generating any profits in order to use the multiple of profits methodology, then looking at its realizable value of its assets is probably the most appropriate valuation method. And for early stage businesses, again, where it might be pre-profit, looking at a discounted cash flow might be another methodology to use, where the value is arrived at by looking at the predicted cash flows of the business, discounting those to reflect the level of risk, and trying to work out the net present value of those forecast cash flows. But as mentioned, I'm just going to concentrate on the multiple of profits method this morning. So the multiple of profits method it involves a very simple equation, which is looking at the underlying profit of a business and then applying an earnings multiple. So dead simple, but the difficulty really is working out what the underlying profit is and using judgment to arrive at an appropriate earnings multiple. So I'll talk more about those in a moment. The multiple of profits method is applicable for most mature profitable businesses. And that simple equation will give you a cash and debt-free or enterprise value for the business, which is the kind of the headline comparable number that can be used. And that debt and cash-free figure then needs further adjustments to work out what the actual equity value of the company's shares are. And again, I'll talk more about that in a moment. So the first sort of side of the equation is the underlying profit, and which profit do we mean? Usually, it's operating profit, which is the profit before interest and tax of a business. If it's a business that's has intangible assets on the balance sheet which are being amortized, then again that amortization cost would also be stripped out of the profit figure, so EBITDA would be used. It's very common that EBITDA it is used for valuation. So this is the same as EBIT or EBITDA, but stripping out depreciation costs as well. And that's fine so long as the future capital expenditure needs of the business are not significant. So if it's a service-based business, EBITDA would be fine. If however, it's a business that involves an extensive level of ongoing sort of capital expenditure, so it could be a transport business that has a continual need to buy new trucks, then excluding depreciation from the profit figure doesn't make any sense, because that's equivalent to what cash needs to be reinvested in the business going forward in order for it to continue trading. So for that sort of business, using operating profit rather than EBITDA is important. So we're looking at the underlying, or trying to work out the underlying profit of a business rather than just its latest sort of reported profit. So it's important to kind of analyze the P&L and make adjustments if appropriate for any exceptional income or expenses that might be skewing the profit figure. Probably the most common example of this would be where management receive lower than market rate remunerations. That could be because they're the shareholders of the business and they choose to receive dividends instead of salaries, and therefore there's an adjustment needed to the underlying profit to take account of that. Again, we're looking to work out the underlying profit, so it's not just the most recent period's profits that's important. Sometimes it's appropriate to take an average over the last few years to try and work out, on average, what the underlying profit is. If it's, however, a business in a growth trajectory, then taking an average over the last few years wouldn't be appropriate, and you might even be leaning towards a current run rate profit just based on the most recent quarter's results, or maybe even looking at forecast results for next year if those are nailed on. So once you've got your underlying profit number worked out, the next step is trying to arrive at an earnings multiple. And the earnings multiple to use depends on the overall quality of earnings in a business. And there's numerous different sort of factors that will go into determining what the quality of the earnings is. But most of those sort of different factors, they all come down to risk and growth opportunities. So businesses that are a lower risk and have the potential for high growth will have a higher multiple. Risky, and conversely, risky businesses with low growth will have a lower multiple. So the kind of specific things that we'll look at when trying to work out the multiple will be whether the business has recurring revenues, and this is something that buyers are understandably very, very keen to have, looking to have a business where you can more or less sort of guarantee a certain level of turnover each year based on repeat business and contracts. Barriers to entry. If it's a business that has a particular specialism or technical expertise or licenses that are needed to trade, those businesses are going to have a more secure market position, have lower risk attached to them, and will have a higher multiple. The market position of a business will have a bearing. If it's a market leader, that will again sort of lead to a lower risk profile and a higher multiple. The company's spread of customers is a very common sort of factor that will have a bearing, possibly a significant bearing on the multiple. Some smaller businesses might be reliant on one or two customers for most of its turnover. Those businesses are high risk and will have a lower multiple. As I mentioned, growth potential feeds into the multiple, and if it's a business in a particular high growth sector, again that will lead to a higher multiple. The strength and depth of a company's management team will feed into the risk profile. So a smaller business that's reliant on one or two key individuals in the management team is going to be less attractive to buyers and have a lower multiple. So sector is important in that some businesses within a particular sector will have a similar sort of risk profile, similar sort of growth potential, and therefore the multiple will be similar. But it's important not to sort of simplistically sort of think that every company in a particular sector will have the same sort of multiple. The multiple is much more dependent on individual factors relevant to a particular business rather than the sector that it occupies. Can we go back to the last slide? So the earnings multiple does vary dependent on all of those different factors, but generally speaking, most small businesses tend to have a multiple somewhere in the range sort of 3 to 5. There are plenty of outliers. There'll be some businesses that have a lower multiple, particularly if it's a risky business in a unfancied sector. So, for instance, construction contracting is not an attractive sector for investors or trade buyers. You might find the multiple is less than 3. Conversely, software businesses where there's a high growth potential and a lot of repeat revenue, then the multiple may well be considerably in excess of 5. So once you've worked out the debt and cash free value or enterprise value, the next step in the process is to work out what the value of the company's shares are, and that will depend on what the balance sheet looks like. So if there are any surplus assets on the company's balance sheet, and the most common one is cash reserves over and above what's needed for the company's working capital cycle, that surplus cash would be added to the cash and debt-free value. Very often as well, companies will own freehold property, which they may also occupy. If that's the case, in order to make the valuation comparable with other businesses that perhaps rents their premises, it's necessary to make an adjustment so that we typically assume that the company would rent its premises, will include a rental charge in the underlying profit figure, and then add the market value of the property as a surplus asset to the valuation. Any debt on the company's balance sheet will be deducted from the valuation, and sometimes it's necessary to use judgment to work out which debt should be deducted and how much. Sometimes it's straightforward, and if a company has £1 million owing to the bank on a loan, that would just come off the valuation. But there might be some sort of balance sheet items that have debt-like properties. So, for instance, deferred income. If customers have been paying the company in advance of services being provided, that would typically be treated as a debt item and deducted. But again, it might need some careful thought about it, exactly how that is sort of worked out in the valuation. Corporation tax is treated as a debt item for valuation purposes, but other sort of taxes, VAT, PAYE, etc., would be treated as working capital and sort of feed into the normalised working capital adjustment. So normally when we're sort of talking about a cash and debt-free value for a business, that will assume that the business has a normal level of working capital, and that's typically worked out by looking at the sort of monthly balance sheets of a business and taking an average of the company's working capital over a length of time. For some small businesses, that level of information isn't available, and again, it needs some professional judgments to work out what a sort of a reasonable estimate of the company's working capital requirements are. So the working capital adjustments will sort of feed into the surplus cash adjustments, and we'll basically try to arrive at how much cash is sort of needed for working capital and how much cash is surplus and can be added to the valuation. Just a further note on equity valuation is that it's important not to take the cash and debt-free value based on a multiple of profits and then add on top the net assets of a business or the business's working capital and fixed assets. The cash and debt-free valuation is inclusive of all of those assets that are needed to actually generate the profits. So just a couple of other things to touch on, sort of related to valuation. There's something called the strategic premium, which is where you might have a corporate purchaser buying up a smaller business and looking to absorb part of that business into a wider operation. And in this sort of situation, a bigger trade buyer might be able to generate a lot more profits from the company that it's acquiring than it would do by just leaving it to continue trading as a standalone business. So it could be taking its intellectual property or products and then sort of developing them faster and selling them to a wider customer base, looking to sort of close down production facilities and move them elsewhere. So making significant changes to how a business operates. And by doing that, it can create a lot more value and be in a position to pay a higher valuation than would otherwise be the case. But this sort of situation doesn't always come about. Very often, trade buyers do simply want to buy a business and keep it running relatively autonomously, and those sorts of synergies and efficiencies don't really come into play. And very often, trade buyers don't wish to pay a premium anyway, and they see that any sort of cost savings and efficiencies that they can drive from a transaction belong to them, and they are unwilling to pay a higher premium just because they can benefit from those factors. So it is dangerous to assume that a big sort of corporate will always pay a strategic premium. It really does depend on the circumstances. It depends on whether there's a number of competing bidders, and how motivated that trade buyer is to actually make an acquisition. If they've got a strategy that's dependent on buying up lots and lots of smaller companies, and they need to pay a premium to do that, then yes, that strategic premium might be possible. Otherwise, it's likely it won't be. And just one final thing on valuation. Is there a tendency for owners of small and medium-sized entities to overvalue their businesses? I think that's probably the case, and that comes down to the fact that as the owner of a business, it's worth more to you than it is to somebody else, and that's because as well as it sort of generating profits, it usually provides well-paid jobs for the owner of the business, and very often their family members as well, and therefore selling the business. If you're looking to sell the business, you're not just sort of selling the profit stream, you're also giving up your job, and therefore the business owner is very often in a position where they can maximize their returns by delaying a sale until a point further into the future. So for that reason, sellers often have price expectations above what buyers might be willing to pay, and that sort of mismatch, it often only sort of aligns when there's a specific trigger as to why a business owner wants to sell, and usually that comes down to wanting to retire, or health concerns, or some other specific factor other than just wanting to cash in. So just to expand on that, the reason why buyers will look at might have a lower valuation than sellers might place on their own business is that that they're an outsider. They will be looking at the risks more objectively than somebody within the business. So thinking about the risks I've mentioned before, if it's a business that is reliant on one or two major customers, the owner of the business might not feel that's a risk because they have personal relationships with those customers stretching back many years. Whereas from a buyer's perspective, they're coming into a business, they they will see that as a major risk, that a change of ownership could lead to those customers looking elsewhere. And also buyers are often in a position where they can pick and choose which companies they acquire, and therefore that they will be looking for those business owners that are motivated to sell, and that they can get the best value for the investments they're making. So just to wrap up on what I've talked about, firstly, we strongly feel that a valuation would help all business owners. It's really important that they understand how valuations work, what the valuation of their business is, and then they can be in a position to the best position to grow that value over time. Be beware of free valuations. As I've mentioned, it does require experience and professional judgment to work out an accurate valuation for a business. Valuations for most profitable businesses are derived from its underlying profitability, and then applying a multiple, and again, it comes down to judgments and experience to kind of work out what that multiple is. And finally, it's not just a case of working out what the cash and debt-free value is. It's also important to kind of work out what the surplus assets and debts are in a company as well, in order to determine what the actual equity value is for a company's shares. So finally, how can we help? We regularly carry out valuations for clients. Our valuations are based on analysis of a company's accounts, management accounts, forecasts. We will sort of take the time to learn about a business to make sure that we understand it in enough detail to give a proper view on what the multiple and the valuation should be. So we'll set out our conclusions in a report which detail our methodology and all our calculations, and the sort of the key factors that are driving the multiple. That report will typically be sort of 12 pages long, and we can use that as a starting point to give further advice if that's required, and that could be our assessments as to how saleable a business is, if you're looking to sell your business, and also whether a management buyout might be feasible, how that could be funded and structured. So if you are at all interested in us giving a view on valuation, please do get in touch. We're very happy to meet with business owners to talk about any aspects in relation to their exit planning, and buying and selling businesses, and we can offer meetings on a no obligation basis. And finally, we like to forge close relationships with accountants and business coaches, and again, very happy to arrange meetings afterwards to see if we can work together.
Thanks, Greg. So we're on to the questions and answers now. We've just had one question so far. There's still time to ask a question if you wish to, using the Q&A icon. Alternatively, if you prefer just to email us after the webinar, if you want to ask a question about your business, we'll ask the question by email and we'll pick up the phone and have a quick chat to you on a one-to-one basis. So the only question I've got so far, Greg, is one about the recent impact of interest rates going up and the effect that has on valuations.
Okay. So I think we've not sort of seen any direct evidence of multiples changing as a result of the sort of recent increase in interest rates and the sort of slow, the minimal levels of growth in the economy at present. As I mentioned during the talk, it tends to be individual factors affecting businesses that have the most impact on valuation. But certainly, the increased interest rates aren't helping get transactions done, and logically will feed into valuations in some shape. So interest rates going up by 5% over the last year. That's had a really big increase in debt costs, so that will make management buyouts in particular more difficult. And another factor that might also have a bearing is the increase in corporation tax this year from 19% to 25%. That's going to take quite a bit of cash out of companies going forward, which might have a knock-on effect on valuations.
Okay, thanks, Greg. We've got two more questions. It's always the same. Once the first question's asked, it tends to open the gates to further questions. So we've got two more questions. The first one is, how do you view costs that support lifestyle, e.g. assets costs that suit the owner more than the business? I think that's a fairly simple one to answer.
I just said that one again, Andrew.
How do you support? I think we're talking about private costs that are going through the business that support the
Right.
lifestyle more than are needed to drive the business forwards.
Yeah. So if there are sort of exceptional costs running through a company's P&L, perhaps related to sponsoring sort of local sports teams or owning a motorhome or something in the business, then those sort of costs would be stripped out from the underlying profit number, so they wouldn't impact the valuation.
Yeah, we do see those sort of costs on a fairly regular basis, whether it's the Spanish villa or the yacht or the sponsorship of the equestrian team, when the daughter's in the team. We see those costs a lot, and we understand that a purchaser. What you're trying to do is put yourself in the purchaser's shoes. What cost would a purchaser not continue to incur going forwards? And we add those back, so it doesn't affect the underlying valuation. The next question I've got is, how do you manage the unrealistic value expectations of vendors and bring them to see the true value to be able to get a deal done? Which is, do you want to have a go at that, Greg?
Yeah, I mean, sometimes that's difficult. So, but if we're acting for clients, then part of what we do is make sure that our clients has a clear understanding of valuation right at the outset before they make any sort of decision about seeking a sale. So that's how we look to kind of make sure expectations are managed on our side. If we're acting on the buy side, there's a business that our clients are looking to purchase, and the vendors on the other side have unrealistic expectations, that can be very, very difficult. Hopefully they could be persuaded by sitting down with them and talking about how the valuation has been arrived at, and what the market will pay, but that's not always possible to achieve, especially if they're lacking sort of a clear motivation for wanting to sell. If they're happy to continue owning the business for a few more years to come, then it can be difficult to get around that.
Okay, well, thank you. That's all the questions. But as I say, if you want to email your questions through to us, particularly if they're specifically about your business and obviously confidential, then please do so, and we'll respond to them. But thank you for listening today. The webinar has been recorded and will be put on our YouTube channel later today, and we'll send the links out to everybody in the next 24 hours or so. So if you have missed part of the webinar, if you joined If you couldn't join at the start, or you've had to had distractions during the webinar and you want to watch any that you've missed, the webinar will be on YouTube. So thank you very much for listening, and I'll bring the webinar to an end at this stage. Thank you.
Thank you.